Bethokia Dumedisa. All protocol observed. I will not go into introducing the panel. I think I'll refer you to the program for that. Besides, their faces have not changed much from the photos that are posted on there. So it should be easy to follow who's who. Am I audible enough? I'm literally shouting. Is there any tech support we can get to up the volume? Thank you. Any better? Okay. Right. I'll delve right into the discussions in the interest of time. I think Stacey had done a good job earlier on in terms of setting the tone for this particular discussion. One of the things that you mentioned earlier that sort of stuck out, and I'm sure it will as well with a lot of the SMMEs, is that bank financing is just structurally not ideal. But traditionally, the prevalence has been the use of bank lending by your SMMEs, your entrepreneurs. What are you seeing? Just on a global, from a global perspective, how are these trends sort of changing, right? And what are the drivers behind the trends that are now evolving?
Yeah. Fortunately or unfortunately, I think the trends have not evolved very much. They certainly haven't evolved enough, I would say. Bank finance is still very much the most important source of finance for small and medium enterprises and for enterprises globally as well. Once you get to what we call in the US a kind of a mid-market level, then other kinds of finance start to kick in. More private equity finance, business development corporation, BDC finance. So banks start playing less of a role. And then when you are a very early stage company, in many countries, some of, again, private markets start kicking in, such as angel finance, venture capital funds, and these are facilitated in many places. In the UK is a leader here, and we can talk about that a little bit more in terms of regulation, followed by Asia, I would say, in terms of sort of these fintech-type private finance platforms, the crowdfunding platforms, the online lending platforms. But unfortunately, it's really still a bank credit story, I would say, for the most part. Now, having said that, I do know several institutions and institutional investors that are investing in Africa, and they do often want to take equity positions in companies in Africa. And the companies tell them, no, please, we just want a loan. We don't want to give you part of my company. It's my company. Stay away from my company. But just can you lend me some money, please, in my local currency? And of course, that's a bit hard to do. But
okay, right. Having heard from Stacey touching on the few options that are available out there, Mr. Khaitsalu, I think being the man behind government's investment arm, what's been your experience with the SMEs and perhaps even the larger local corporates, right?
Yeah.
And how can we go so far as broadening the financial instruments that are available to these groups?
Yeah. Okay, I think it's an excellent question. And I think my starting point really would be around trying to define the SME space a little bit more. And I think when I look across, in our experience looking across Botswana, is that this space remains extremely wide, and we have different people who call SMEs different things. I mean, if you look at Leah, for instance, who deal with thousands and thousands of SMEs, their definition is a company with a turnover of 5 million pula. Yet you look at other institutions, you look at, for instance, the EDD program, which the government is rolling out very aggressively. They're defining SMMEs as those with a turnover of up to 15 million. And I know that other people look at numbers much higher than that, going up to as much as 20, maybe even 25 million as turnover for an SME. And I think there's a bit of work that needs to be done to really crystallize so that when we talk about requirements, we're talking about the real requirements. I think there's a danger that if it's too wide, then you don't get the right requirements and the needs of that specific sort of SME. So I think that's kind of my opening statement, and that's certainly what we've seen over at BDC. But I think we have seen that traditional forms of bank lending are predominant, and they don't seem to meet the needs of SMMEs. And I think one of the things that we're looking at BDC is really the idea of financial intermediaries. And I think this is an area where DFIs can play a particularly strong role in financial intermediation for a number of reasons. I think one is DFIs, we tend to be very pro-entrepreneurship, which is a very good thing. I think we look at entrepreneurs, we look at their passion, their energy, their skill sets over and above their business plan and everything else. We also look at, we have strong sort of credit capacity and risk profiles that are very different from what, Stacey. We also, we have a very different risk profile as well, which I think can be quite suited to some of the SMEs that may be coming through as a DFI fraternity, not just BDC, but the whole DFI. And I think what's also important is we also bring as DFIs strong monitoring and implementation capabilities. So when someone is young and starting, or not young, when a business is in the early stages, being able to monitor and assist with implementation and have that capacity around project management, project execution, I think that's a very, very big plus.
Right. Okay. Thanks, Mr. Faisal. We have here present in our panel representative. A representative from one of the companies, Sefalana, that has managed to successfully access other sources of capital. Mohammed, what's been your real sort of advantage in terms of value that SMMEs or unlisted companies can actually derive from raising capital in the stock markets?
Okay, thanks, Boto. I mean, we, as a well-established listed company, have the benefit of a reputation behind us. I think when you speak to an SME, both here and in South Africa, and you mentioned the concept of listing, there's an initial resistance and the fear of regulation. But in practical terms, what does it actually mean from a day-to-day basis? There's obviously a listing cost, and that's the subscription fees or whatever those are. But to be honest, those are not significant in the grand scheme of things. The real challenge is around making sure that your infrastructure is set up in such a way that you are now able to comply with the rule book, the listing rules. The listing rules that the Botswana Stock Exchange issues to us as listed companies varies to a slight degree to other listed stock exchanges, but fundamentally the principles are very similar. There's corporate governance requirements, there's reporting requirements, and what you'll probably find is a lot of SMEs are perhaps not structured with sufficient resources. They may not have an internal audit department. They may not be producing financial results on a monthly basis within, say, 2 weeks of the month end. They might not have a board structure, a sub-board structure with remuneration committees, etc., etc. So all those aspects take some time to establish and are possibly seen as hurdles or obstacles to getting to a position where you are compliant. But in my view, those are actually not big issues. When a company is thinking about, do we go to the stock exchange for money or do we take out a debt instrument, the concept of regulation shouldn't be at the forefront. It should be a byproduct of the decision you finally make. So if you look at what's my funding requirement, is it large enough to be funded by a debt instrument, or do I need to look at a wider shareholder base? Perhaps you might consider the tenure of the money that you require. So typically when you go to a bank, you might get a 7-year payback period, etc. And that may not be suitable for your requirements. So I think the important thing is to ascertain exactly what you need, for what purpose, and try to match it against a profile. So let's say you then conclude that you want to go onto the listing and be a listed entity, and therefore the regulation is a byproduct. All those things that I mentioned about the governance structure, the reporting side, those are actually advantages. Why wouldn't you want to have monthly reporting done within 2 weeks of your month end? That gives you the ability to respond to issues, to run your business. Why wouldn't you want to have a board with independent board directors giving you a challenge at every decision making sure that you're sense checking that you're doing what you should be doing. Why shouldn't you be thinking about your shareholders who you are ultimately performing for? So all those, in my opinion, are advantages of being on the stock exchange rather than a hindrance. And I think once we cross the fear boundary of what regulation actually means, for an SME looking to raise funding from a long-term perspective, listing is quite a good opportunity, because you may have a growth strategy which spans a number of years, and you might then look to tap into the equity market through a rights issue, etc., periodically. And having that avenue helps you establish that. And then I think Stacey mentioned in her initial discussion the concept and the importance of reputation. And I mentioned it when I first started to speak today. Reputation is critical when you're going back to the market to ask for funds. If you go to the market and present a story and ask the shareholders for some funding and go and deliver on that or exceed that expectation, you're more likely to go back a couple of years later and get that same level of funding from the shareholders, purely because you got that reputation. If, however, you fail on those, you work against yourselves and you might struggle to get that second funding. But also, I mean, I had a discussion with somebody this morning about the concept of secondary listing on a stock exchange in South Africa, for example. And again, if we as Cefalana wanted to do that, it's a tool available to us in the context of the reputation that we've established for ourselves in the local market. So overall, I'd say there's a lot of benefit and advantages of being on a listing. And I would encourage SMEs not to be too concerned and focus too much on the regulation, because at the end of the day, the regulation does help give you a structure within which to operate.
But really, how easy a road journey has it been, right, to get yourselves listed? So one aspect is, okay, there's regulation. The other is also just the capability and the know-how that lies within the SMMEs. Apologies. I was just asking Mohammed really how easy it has been to travel that journey to get to the point of listing. Because aside from just regulatory issues to take into consideration, there's also the know-how, right, that exists within SMMEs to be able to know how to, in what manner to progress, right? There's also cost implications. Getting in advisors to basically set the path for you to eventually getting listed. So with that, how do you actually, what's the real impact in terms of cost of funding that exists for companies that want to go the listed route?
Get in readiness. Okay, I mean, Botswana, Cefalana was the first company to list on the Botswana Stock Exchange 42 years ago. That was before I was born. So I wasn't around to go through the difficulties that might have been experienced in terms of listing. However, I think in terms of readiness, the listing rule book sets out prescribed requirements. You have to set up X number of set of results to present. There's a number of boxes that need to be checked. And that's, again, the benefit of the listing. You have a rule book, you have some guidance on how to get there. And if you are falling short in a certain aspect, there's encouragement and guidance on how to get there. Certainly, smaller companies who are too far away from being ready to list should be looking at other alternatives, debt funding, etc., through the banks. There are other institutions like CEDA who do promote and assist local businesses in terms of funding. But I think if you are seriously contemplating getting onto the exchange, you're more or less geared up to be heading that direction. And if you're not, it shouldn't be too difficult to get there. From a cost perspective, again, it's setting up your teams, making sure you've got the structures in place. Yes, you'll have a bigger board, perhaps subcommittees, etc. They'll have sitting fees, you'll have directors' fees, etc. But that's all part and parcel of becoming a bigger player in the market that you're playing in. And ultimately, once you get the funding, those regulatory costs or the cost of enhancing your infrastructure are really not a major issue once you're up and running. So, from a cost perspective, I don't think it's a huge issue.
Maybe if I just respond to that quickly. I think I think it's from our perspective, it's not really about the cost of listing. I think what we really try to share with SMEs when they come through to us is to talk to them about what are their objectives, or what are they trying to do, what are they trying to achieve, and then what are the options that are available to them. And I think certainly listing is one of those options. And if it's important to you and it's necessary for you to go that route, then I think you just have to go that route.
You just have to do it.
But then I think what's important is that we spend a lot of time explaining to entrepreneurs what some of those options are that they can take. Some of the new sexy stuff you're talking about around crowdfunding and all that new stuff, and even shadow banking. I mean, people talk about shadow banking a lot all the time. But then some of the common sense stuff around factoring, around accessing DFI funds. So it's really about what does the entrepreneur want and what are the options available to them.
Yeah.
If I can just jump in. Last year, I was involved with 3 listings on the JSE. And from what we see in assisting companies with their route to listing is that there's often a huge underestimation by management of the effort that is required with the listing. It's not to say to turn people off listing, but if you plan for the listing, so if you are wanting to come to the market, you need to start planning for that well in advance. And you need to start thinking about the things you have to put in place, like your financial statements, who your auditors are, your board, getting your corporate governance right, all those little steps, so that by the time you actually get to the point where you are embarking on that actual listing process, preparing your documentation, going through the process with the stock exchange and going out to market and doing roadshows, that all those things are in place and you are ready to list, because it is a huge draw on management, and it usually runs concurrent with something like an audit, which puts management under huge strain. And the SMEs very often don't have a lot of staff. The management teams are small. So that would just be the one point I think people need to make sure they plan it properly.
I mean, if I can just share with you a live example. I'm in discussions with a South African company that it's an SME, it's a well-established company, and it's probably almost 50% of the size of Cephalana. So quite a large company, not listed on the stock exchange. And I've been trying to encourage them to look towards listing in the future. And the issue about cost hasn't even come up in the discussions. Cost is not even an issue for them. The issue about regulation has, and that again comes back to the point about not knowing exactly what that regulation means, but I think that's just an educational perspective. But in this particular instance, the biggest issue or concern to them is giving away autonomy from a family type run business to having to be accountable to somebody else, to having a remuneration committee dictate to them what their remuneration will be, whereas in the past they could simply, between themselves, son, father, sister, whatever, agree that the remuneration is going to be such and such. So that is the biggest stumbling block from that company's perspective. So I think the focus on cost is not really a major issue in the grand scheme of things, and it's other factors that sometimes hold companies back in terms of going through a listing. But the benefits, in my opinion, outweigh those considerably.
And one of those that have been mentioned is just around regulations, right? So we're seeing tightened regulations across most of the financial markets. So to what degree do regulations really impede the ease by which SMMEs could go the listed route? How do we actually get around to making the regulations a little bit more attractive and more conducive to support these initiatives?
Are you asking me?
Anybody?
Well, based on our survey work, a very interesting, again, kind of irony in that companies don't appreciate all of the regulatory hurdles that they have to go through. But if you ask them to rank what is most important to them in an exchange ecosystem, it is a good, high-quality regulatory environment. It is always the most important thing. Because if they're going to go through all this trouble and they're looking for that branding of being in a good company and a good company, that's not going to happen unless the regulatory environment is upheld and it is strong. And so You know, if the test is easy to pass, I mean, you don't like studying for the test, but if it's easy to pass, then it's not meaningful that you've passed it, right? So there's always a little bit of this tension. Having said that, though, when regulators sneeze, it is these SMEs always that catch the flu the most, because everything is, regulation adds costs. And at least in the United States, the cost for a bank, so just thinking about even how bank regulation impacts SMEs, the cost for a bank of giving $1 million loan is the same as the cost of giving a $100,000 loan. And so when those costs go up, banks, at least in the US, they're just not interested in loans less than about $250,000 because the regulatory burden is just high on them. And this impacts, this is kind of some of the structural issues that we talked about before. You know, I used to run the market for SMEs at the NASDAQ microcap market. And this was during this Enron debacle and the dot-com bust and all of that. And there's legislation that came out of the United States called Sarbanes-Oxley legislation. It was this big regulatory sort of thing. One of the pieces of information, and they passed it in like 10 days. One of the requirements was that the audit committee a majority of the members of the audit committee had to be external. Well, these companies had one person on the audit committee. And you know, when the writers of that legislation were thinking about this, they weren't thinking about that. I can't tell you, I probably spent a half of a year of my life trying to define and figure out what does majority mean. You know, does it mean they now have to have 3 because can you have a majority? So you have to be very careful, I think, and think proactively about the impact of SMEs of regulation. But having said that, companies don't want to be a part of the Wild West either. They want to be part of a regulated market, a well-regulated market.
So if we bring that a little bit closer to the local landscape, what's been, say, Mohammed, your encounter with the regulatory framework here to support your cause?
Look, and I'm not just saying this because this is a BSC conference, but generally speaking, the BSC is a fairly easy to get along with regulator. So, you know, thank you for that. But in terms of the regulations, they're not overly onerous. The new revised listing rules are currently being reviewed. You're never going to please everybody. And ultimately, when the revised listing rule comes through, the regulation is going to be a little bit more tighter in terms of timelines, etc. But we've all had the opportunity to feedback to those proposed rule amendments. And, you know, to the credit of BSC, they do take your comments on board. And, you know, we're just waiting to see what the final one looks like. But generally speaking, the regulator is not such a bad regulator here. I don't know how that compares to, say, the JSE, and I'm sure the JSE, because they have further you know, progressed and developed a little bit further than us, might have some additional requirements. But certainly in the local market here, it's nothing to be scared of in terms of as an SME considering entering the regulated market. So from our perspective, we're quite happy with the regulator. And we would encourage the continuous dialogue to continue, the consultation, and we would encourage them not to tighten the rules too much and just let us do what we're doing in the manner that we're doing it.
If I can just jump in to make sort of 3 distinctions on regulation. One is the uncertainty of regulation. And so that is the absolute worst thing, is that you just don't know when the regulatory goalposts are going to shift. That is the worst outcome for companies because you're always kind of chasing. So what you need is a stability in the regulatory framework, I think most important. And then the second distinction I would make is between the content of regulation and the process of regulation. So even if the content is a bit onerous and the bar is a bit high, does the process at least work? When you call, do you get somebody answering the phone, or do you get, if this, press 1, if this, press 2, and then nobody ever gets back to you? Can you do it electronically? Can you use technology? Are the regulators friendly? Does the first person you call know the answer, or do you keep having to go shifting back and forth between people and you never get an answer? Are they responsive? Are the times, the time frames for you to submit things, are they reasonable? All these things can be improved even in a slightly more onerous, to lack of a better word, a regulatory environment.
I just wanted to add, I think people tend to look at regulation in quite a negative light, and we don't see the benefit of the regulation. But the purpose of the regulation is there to protect investors and stakeholders. And that very regulation that is potentially a little bit onerous is what makes your business more attractive. So when you are looking to raise debt financing, those providers of debt, they like listed entities because they know those entities are better regulated. They generally have good corporate governance policies in place. So that's a plus. From going out to the market and doing additional capital raises to obtain further capital from the market, as a regulated entity, people are attracted to that. They want transparency. They want to know that you are in a well-regulated market, that their money is safe. So I think the benefits of the regulation shouldn't be pushed aside, when one has these conversations, that they serve a good purpose in meeting the objectives that you're trying to get to.
I mean, I think just another way to slice and dice that, I think there's, I agree with Mohammed in terms of the regulations for the stock exchange. I think there's not a lot of issues over there. And we have 3 unlisted entities as BDC that are on the Botswana Stock Exchange. But I think there's also, industry-specific regulation, which I think is where the challenge, lies with many entities, as well as I support broader regulation around, ease of doing business, right? I mean, how easy, and I think that's where a lot of companies would challenge.
How many regulators do you have?
And so how hard is it? And so it's not whether you're listed or not, it's just really how easy is it to do business within the broader environment that you're operating in. I think that's where a lot of businesses are challenged, whether they're SMEs, whether they're large corporates, whether they're listed or whether they're unlisted.
Stacey, you've done tremendous work through the Milken Institute in terms of making efforts to create opportunities for entrepreneurs to raise capital, to create jobs, as well as to really improve wealth on the whole. So in your experience, how do you sort of see innovation disrupting the capital markets, right? And from that point, how can regulators better position themselves to move ahead or keep up with the changes that are happening?
Okay, that's about a 45-minute answer, but I will. I know people do want to go to lunch. Let me just say a couple of things. First, I think it's very trendy right now to talk about kind of fintech and fintech innovation. Some of it is very innovative, and some of it is quite disruptive for sure. But some of it is also just making current capital markets and financial markets more efficient. It's kind of just streamlining processes, getting applications to go through further, faster, and the like. So it's just kind of use of technology. I think where fintech has been the most innovative, though, is in a new way of looking at credit. So in the United States, look, for small and medium enterprises, there is no distinction between personal credit and business credit, because the balance sheet is your household balance sheet, right? You're a young, or not even, doesn't have to be young, entrepreneur, but you are putting your household balance sheet behind this company in the very early stages. And so we had this thing in the United States called the FICO score, and you get the score from 1 to 700, and nobody knows, it's very non-transparent, nobody knows what goes into it. But these fintech companies have come along, and you know this already, but they've looked at other alternative ways of judging your credit based on your behavior, especially your online behavior, so that, what kinds of things do you buy, what are you doing with the credit card? This kind of information is quite readily available now. And then backing out of that, a credit score for you as a person or you as a small company. And that is actually quite innovative. Now, in terms of regulation of that space, I mean, we're having a very hard time in the United States with this because we've got 50 states, 50 different state regulators, and in every state, you have to be licensed in that state in order to issue securities to the public. Okay, well, that seems very straightforward. But what if you're an online crowdfunding platform and you're based in Mississippi? And what if some guy from Michigan, comes online to your crowdfunding platform and wants to invest, but you haven't registered in Michigan? Because you didn't think about it. And so now, everybody's kind of just trying to figure out how to craft existing regulation so that it is responsive to these new kinds of fintech challenges. And you can see that happening. Kenya's got a very interesting regulatory regime where things are allowed to percolate a little bit before they're absolutely regulated. And no wonder Kenya is in the lead of these fintech and payments. We did this in the United States in the Clinton administration with eBay. All of a sudden, there's this online auction And it was a Democratic administration, so the first instinct was, okay, let's regulate this. And then they stopped and said, well, we don't even know what this is. We don't know how big it could become. We don't know. So let's just let it incubate a little bit and kind of see how it is. And that was a very wise choice in the end for that. And we are seeing globally now, I think, 20 different countries have this kind of fintech regulatory sandbox where they're just taking a bit more of a wait-and-see approach before they kind of come down and regulate the space, because you're just not exactly sure what the parameters of investor protection really actually need to be. And I think I'd end by, I guess, making that point more broadly that, and again, I'll just draw on the United States experience, the idea that, Congress could pass a law, the SEC would write the rules, write the legislation, and then have a 6-month comment period where people would come and comment, and then that would be the regulation for the next 10 years, is not a system that is going to survive rapidly changing, rapidly innovative financial markets. And so that regulatory paradigm, that regulatory mindset needs to evolve with the speed of financial markets. And one way that it needs to evolve is to embrace this kind of testing of small pilots, piloting certain kinds of regulation, having a control group and a variable group. I mean, there's this thing now going on, the bid test rule. It's very technical and very boring, but what's exciting about it is that the SEC has said, okay, over here for this small group of companies, we're going to implement this rule. And over here, we're going to have a control group where we're not going to implement the rule. And then we're going to kind of see what happens and wait and see. And that mindset is actually quite revolutionary. And it's easier said on a panel than actually done and executed. Thank goodness it's not actually my job. But that's the kind of, I think, evolution in mindset that needs to happen in the regulatory space as well, at least in the US.